Welcome in Chris Grisanti, the Chief Equity Strategist at MAI Capital Management, and Melda Mergen, Deputy Global Head of Equities at Columbia Threadneedle Investments. Guys, welcome. Melda, so what do you do here with these big, richly valued at this point stocks that not only seem to be more at risk from these rising yields, but also make up a pretty heavy weight in the S&P?
Yes, there's definitely a portion of the market where the valuations are stretched, and we are very careful with those. These are high multiple stocks, especially when they don't have earnings. They are supported by the low interest rates, and that cohort is a big area of focus for us, and we are generally underweighting those stocks. But we don't really expand that to the overall market. There are companies still in the growth universe justify their multiples because they have earnings potentials, and we will continue to invest in those secular trend winners. So,
Chris Grisanti, though, I mean, what do you do if you are a retail investor, longer term, who's got a bunch of money in index funds, as many do, because that's what they tell retail investors to do, and you're going to probably experience some turbulence in those because of the heavier weighting toward those very sorts of stocks that we're now hearing to avoid?
Sure, John. Well, first, thanks for having me. Second, I think it's important for retail investors to take a deep breath and stick to their plan, but also to recognize that we've entered a new, I'm calling this last week in the market the first post-COVID market that we've had. For the first time, we're looking ahead to a vaccinated world. Things are growing much faster. You no longer need the security of these certain earnings winners like Facebook and an Apple. Having said that, I think that the rotation has gone a bit too far. And so before you panic, I would take a deep breath and just like Medla said, look at the earnings.
Shepard Smith here. Thanks for watching CNBC on YouTube.